With whole life, the insured is covered for their entire life or until age 100, whichever comes first. Because the insurer is almost certain to pay out a death benefit, whole life premiums tend to be higher than term insurance premiums. Instructor draws diagrams to illustrate whole life concepts. One key concept in whole life is pre-funding. In the early years of the policy, you pay more than the actual cost of insurance. The insurer invests this extra money and earns interest, a portion of which is paid back to the policy owner in the form of cash value. The policy owner has the right to withdraw this cash value if they choose to do so. In the early years, the whole life premium is much higher than the one-year term premium. But in later years, when the cost of insurance is very high, the whole life premium remains level. Instructor moves on to the topic of endowments. Now, let's talk about endowments, which are essentially a forced savings program. Let's say Pearl wants to retire at age 55 with a $500,000 check waiting for her. She could purchase a pure endowment where she pays $200 per month for 25 years, and at age 55, the insurer will give her $500,000. The insurer invests Pearl's money, pays expenses, and credits interest to her cash value account. Instructor explains what happens if the insured dies before the endowment matures. If Pearl doesn't make it to age 55, the insurer won't keep her money. Instead, they'll pay the cash value to her beneficiary. This is called a pure endowment. Don raises his hand.
What if Pearl wants her beneficiary to receive the full $500,000 if she dies before age 55?
Great question, Don. In that case, Pearl could purchase an endowment with a death benefit rider. She'd pay a slightly higher premium, say $250 per month, and if she dies before age 55, her beneficiary would receive the full $500,000 face amount. Instructor notes the rarity of endowments in the current market. It's important to note that endowments are rarely sold today due to changes in tax laws in the mid-1980s. However, you may still encounter them in your work as an agent, so it's crucial to understand how they function. Instructor introduces the concept of modified endowment contracts. Another concept related to cash value life insurance is the modified endowment contract, or MEC. In some cash value policies, policy owners are allowed to overfund the policy by paying extra premiums to grow the cash value faster. However, the policy owner must be careful not to allow the cash value to exceed the face amount. If this happens, the policy will lose its status as life insurance and become MEC. This will lead to taxation of the interest and penalties imposed by the IRS. Cash value growth is attractive because life insurance has tax-favored status, meaning interest earned on the cash value is not taxed when it's earned. Instructor explains the tax advantages of cash value life insurance. If $1,000 of interest is earned inside a life insurance policy, neither the insurer nor the policy owner has to report it to the IRS. This allows the money to grow faster, as the full $1,000 can earn interest in the following year. In contrast, if that $1,000 was earned outside of a life insurance policy, it would be taxable, and only $750 would be left to earn interest the next year, assuming a 25% marginal tax bracket. Instructor discusses the limitations imposed by TAMRA. Some policy owners took advantage of this tax-favored status to such an extent that Congress passed the Technical and Miscellaneous Revenue Act, or TAMRA. TAMRA allows overfunding, but sets limits based on the growth rate of a 7-pay whole life policy. If a policy's cash value grows faster than that of a 7-pay policy, it becomes a MEC, and the tax advantages are lost. Instructor checks for understanding. Does anyone have questions about MECs or the tax treatment of cash value life insurance? The class is silent, indicating understanding. Great. Let's take a break, and when we come back, we'll discuss premium variations for whole life insurance. The class takes a break and returns. Welcome back. Let's talk about the different ways premiums can be structured in a whole life policy. These variations allow policy owners to tailor the product to their specific needs. Instructor introduces single premium whole life. The first variation is single premium whole life. In this case, the policy owner makes one large lump sum payment up front, and the policy is paid up for life. There's just one premium payment, and then the insured is covered until age 100 or death, whichever comes first. If the insured lives to age 100, most companies will pay out the death benefit to the beneficiary at that point. Instructor discusses the risks and benefits of single premium whole life. Single premium policies can be risky for the policy owner if the insured dies shortly after the payment is made, as they've paid far more premium than they would have under a monthly payment plan. However, if the insured lives a long life, the policy owner ends up paying less overall. Instructor provides an example. Let's say Pearl is 30 years old and wants a whole life policy with a $200 monthly premium. If she's expected to live to age 80, she'll pay $2,400 per year for 50 years, totaling $120,000. The insurer might offer her a single premium option where she pays $60,000 up front and never has to make another payment. Pearl chimes in.
Wow, $60,000 is a lot of money to pay at once. I don't think we have that kind of cash laying around.
Honey, check the bottom of the sock drawer.
That's a common concern, Pearl. Most people opt for the monthly premium payment because it's more affordable, even though they end up paying more in the long run. Instructor explains why insurers offer single premium options. Insurers are willing to offer single premium policies because they can invest the lump sum and earn interest on it. This interest helps offset the fact that they won't be collecting ongoing premiums from the policy owner. The insurer is betting that their investment returns will exceed what they would have collected in monthly premiums over the insured's life. Instructor moves on to level premium whole life. The most common premium variation is level premium whole life, also known as continuous premium or straight life. With this option, the policy owner pays the same premium amount for their entire life or until age 100. Instructor draws a graph with age on the x-axis and a straight horizontal line representing the level premium payments. As you can see, the premiums remain constant throughout the life of the policy. Many clients prefer this option because it offers the lowest possible premium while still providing lifetime coverage. Instructor notes what happens when the insured reaches age 100. If the insured lives to age 100, most insurers will pay out the death benefit to the beneficiary, even though the insured is still alive. At that point, the insured is considered statistically dead, and the policy reaches maturity. Another way of saying this is, the policy endows at age 100. Great job on completing this video. Now it's time to test your comprehension of the concepts we just discussed. This video corresponds to ICAP quiz course number 15. Remember that number. Click the link in the comments section to access the Insurance Class Assistance Program, also known as ICAP. Once you're there, look for quiz course number 15. This quiz will help us see if you truly understand the material and are prepared to move on to the next video. Don't forget, ICAP quiz course number 15. Good luck and keep up the great work.